Welcome back to our channel, where we dive deep into the world of financial giants. Today, we're bringing you an exciting breakdown of four major players in the financial services sector: Blackstone, JPMorgan Chase, Morgan Stanley, and S&P Global. We'll dissect their key financial metrics, explain what each one means, and compare them head-to-head to see which company stands out. Get ready for a roller coaster of insights and numbers that will keep you on the edge of your seat. Let's kick things off with the price-to-earnings ratio, a crucial metric that tells us how much investors are willing to pay today for a dollar of earnings from the past year. Among our four contenders, S&P Global leads with a P/E ratio of 33.95, making it the most expensive relative to earnings. This indicates that investors have high expectations for S&P Global's future growth and are willing to pay a premium for its stock. Blackstone is close behind with a P/E ratio of 32.81, suggesting strong investor confidence as well. On the more affordable side, we have JPMorgan Chase with a P/E of 11.88 and Morgan Stanley at 15.60. These lower P/E ratios suggest that these companies are considered less expensive in terms of earnings, possibly due to more moderate growth expectations or the nature of their business models. Looking at the 5-year average P/E ratio, S&P Global again tops the list with an average of 31.08, indicating consistent high investor sentiment over the past 5 years. Blackstone follows with an average of 25.23, reflecting steady investor confidence. Morgan Stanley and JPMorgan Chase, with averages of 12.08 and 11.01 respectively, show more conservative investor expectations, possibly due to the cyclical nature of the banking industry. The forward P/E ratio, which gives us a glimpse into the future valuation of these companies, shows a slight shift. S&P Global remains the priciest with a forward P/E of 29.94, indicating continued strong expectations. Blackstone's forward P/E drops to 22.24, which still suggests positive sentiment but with a slight tempering of expectations. JPMorgan Chase and Morgan Stanley have forward P/E ratios of 11.99 and 12.39, respectively, pointing to a more cautious outlook from investors regarding future earnings growth. Next up, we have the price/earnings to growth ratio or PEG, which considers the P/E ratio relative to growth. Morgan Stanley shines in this metric with a PEG of 0.85, indicating that it's undervalued considering its growth prospects. Blackstone also shows a favorable PEG of 1.40, suggesting that its growth potential is being reasonably priced by the market. In contrast, JPMorgan Chase has a PEG of 3.74, which may signal that the stock is overvalued relative to its growth prospects. S&P Global's PEG of 2.43 suggests that while the stock is somewhat pricey, the market believes in its long-term growth potential. Insider ownership is another crucial metric, as it shows how much of the company's stock is held by its insiders. Blackstone takes the lead with a substantial 41.66% insider ownership, indicating strong confidence from those within the company. Morgan Stanley follows with 23.47%, which also reflects significant insider stake and confidence. JPMorgan Chase and S&P Global, on the other hand, have much lower insider ownership at 0.38% and 0.11%, respectively. This lower insider ownership might suggest a more widely held public stock or possibly less confidence from the company's executives. Now let's dive into profitability metrics. Return on equity measures how effectively a company is using shareholders' equity to generate earnings. Blackstone leads here with an impressive ROE of 28.4%, showcasing its ability to generate high returns on equity. JPMorgan Chase follows with a solid 16.45%, indicating good management efficiency. Morgan Stanley's ROE of 10.36% is lower but still respectable, while S&P Global trails with a 9.45% ROE, which might raise some concerns about its ability to generate returns on shareholder equity. When it comes to return on assets, S&P Global surprisingly leads with 5.46%, indicating it uses its assets more efficiently to generate profits. Blackstone follows with an ROA of 4.86%, which is solid given its asset-heavy business model. JPMorgan Chase and Morgan Stanley have much lower ROAs of 1.34% and 0.88%, respectively, reflecting the capital-intensive nature of the banking industry. Finally, return on invested capital is a critical metric for understanding how well a company is using its capital to generate returns. Unfortunately, ROIC data is unavailable for Blackstone, JPMorgan Chase, and Morgan Stanley due to the difficulty of obtaining this metric in the financial sector. However, S&P Global shows a decent ROIC of 10.07%, indicating efficient use of its invested capital. The evolution of shares outstanding is a key indicator of how a company's share count has changed over time, which can impact shareholder value. Blackstone is increasing its shares at a compound annual growth rate of 1.85%, which might dilute existing shareholders but also indicates growth or capital-raising activities. On the other hand, JPMorgan Chase and Morgan Stanley are decreasing their shares with CAGRs of -2.92% and -2.15%, respectively, likely due to share buybacks that can enhance shareholder value. S&P Global is increasing its shares at a modest compound annual growth rate of 1.64%. Continuing with earnings per share or EPS, that is another crucial metric, representing the portion of a company's profit allocated to each outstanding share. JPMorgan Chase leads with a solid EPS of $17.33, followed by S&P Global with $14.39. Morgan Stanley has an EPS of $6.07, while Blackstone lags behind with $3.99. However, the future looks bright for Blackstone, with its EPS expected to increase at a compound annual growth rate of 23.5% over the next 5 years. Morgan Stanley also shows strong growth potential with an expected EPS CAGR of 18.45%. S&P Global and JPMorgan Chase have more moderate growth expectations with CAGRs of 13.99% and 3.18%, respectively. Looking at the evolution of earnings per share over the last decade, S&P Global leads with a 15.68% CAGR, showcasing consistent growth. JPMorgan Chase and Morgan Stanley also show positive growth with CAGRs of 14.53% and 12.26%, respectively. Blackstone's EPS growth has been more modest at a 0.66% CAGR, indicating slower earnings growth over the last decade, with huge upsides and downsides during the last decade. On the other hand, the free cash flow per share is a key metric for understanding how much cash a company is generating relative to its shares. S&P Global leads with a 15.25% CAGR in FCF per share over the last decade, highlighting strong cash flow growth. Blackstone also shows positive evolution with an 8.3% CAGR. However, JPMorgan Chase and Morgan Stanley have seen inconsistent FCF per share, which might raise concerns about their cash flow management and future dividend sustainability. For all you dividend lovers out there, Morgan Stanley offers the highest dividend yield at 3.91% with quarterly payments of $0.925 and 27.76% dividend growth over the last decade, making it an attractive option for income-focused investors. Blackstone follows with a 2.6% yield, providing quarterly payments between 80 cents and 95 cents. That reflects its huge inconsistency in their dividend payments, but overall over the last decade its dividend had grown at 7.29%, which is not bad at all. JPMorgan Chase offers a 2.24% yield with quarterly payments of $1.15, and additionally they have grown their dividends at 11.07% compound annual growth rate. Finally, S&P Global offers a modest 0.59% yield with quarterly payments of 91 cents, with a 12.05% CAGR. Operating margin is a critical indicator of operational efficiency. Blackstone leads with a remarkable operating margin of 45.93%, reflecting its ability to generate high profits from its operations. S&P Global follows with an operating margin of 38.18%, also indicating strong operational efficiency. JPMorgan Chase and Morgan Stanley have lower operating margins of 26% and 13.24%, respectively, which may reflect the more competitive and regulated nature of the banking industry. Profit margin, which indicates how much of each dollar of revenue a company retains as profit, tells a similar story. S&P Global leads with a profit margin of 25.03%, followed closely by JPMorgan Chase with 19.52%. Blackstone and Morgan Stanley have profit margins of 18.95% and 9.59%, respectively, indicating differing levels of profitability across the board. Looking at the evolution of revenue and earnings over the last 8 years, S&P Global and Blackstone stand out with very positive evolution, which has been reflected in their market performance. Both companies have achieved higher total returns than the S&P 500 ETF, VO, during the last 5 years. JPMorgan Chase and Morgan Stanley also show positive evolution, but this has not been fully reflected in their market prices. However, both companies have still managed to outperform the VO in total returns over the last 5 years. Finally, let's look at debt ratios, which indicate the financial leverage of these companies. S&P Global has the lowest debt/EBITDA ratio at 2.02, indicating a more conservative use of debt. Blackstone follows with a ratio of 2.68, while JPMorgan Chase and Morgan Stanley have higher ratios of 6.94 and 20.16, respectively, reflecting their reliance on debt for funding. When it comes to debt/free cash flow, S&P Global again leads with a ratio of 2.55, followed by Blackstone at 2.75. JPMorgan Chase and Morgan Stanley have higher ratios of 3.78 and 48.68, respectively, indicating differing levels of debt management and cash flow generation. To wrap things up, let's take a quick look at market cap and average price return over the last 52 weeks. JPMorgan Chase leads with a massive market cap of $585.53 billion, followed by Blackstone with $159.92 billion. Morgan Stanley and S&P Global have market caps of $153.24 billion and $152.85 billion, respectively. Now let's talk about the moment that all you are waiting for, the crystal ball and analyst expectations. Analysts predict varying price targets for the next 12 months. Blackstone's price target is $134.11, representing an upside of 2.43% from its current price of $130.93. My fair value, however, is $116.42, suggesting current overvaluation. On the other hand, JPMorgan has a price target of $224.47, representing an upside of 8.1% from the current $205.80. My fair value is close to the current one, around $198.65, indicating potential fair valuation. Morgan Stanley's price target is $105.91, representing an upside of 11.81% from the current $94.72. My fair value is a little bit lower at $103.60, also suggesting undervaluation. Finally, S&P Global's price target is $538.91, representing an upside of 10.32% from the current $488.51, and my fair value is $383.12, indicating current overvaluation. So we have the most growing companies with the higher prices and indicating a potential overvaluation, while in the other two we have better current valuation but also more concerns about debt problems. So, there you have it. A detailed look at the financial health, growth prospects, and market potential of 4 of the biggest names in finance. Whether you're an investor looking for the next big opportunity or just someone fascinated by the world of finance, these metrics give you the insights you need to make informed decisions. Which of these companies do you have in your portfolio? Let me know in the comments below. And don't forget to like, share, and subscribe for more deep dives into the world of finance and investing. Hit that notification bell so you never miss an update. See you in the next video.